Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. Thank you for joining me today. This is the weekly live stream where we talk about private equity and more sort of higher level business type stuff. And to all you Americans out there, happy 4th of July. Apparently that's a big thing down there. Everybody goes nuts. So, right on. This is episode number 18 in this series of streams where we talk about private equity. And the title today is Why Private Equity Drowns Companies in Debt. And in a way, this is kind of a part two from what we were talking about last time. We were going into return on investment, the calculation, return on equity, return on assets, that kind of stuff. We kind of explored that. And we're going to sort of continue that today because it cuts right to the heart of why people do this, like why private equity is a thing. And one of the more puzzling aspects of private equity is that they load up the companies that they buy with debt. And we're going to examine why they do this. Also, a special shout out goes out, as always, to my YouTube channel members. Membership has its privileges. You guys are awesome. And to my Patreons, to my super thanks donors, those are always cool to get, and to you, my participants. And hopefully my camera is not too bright. I'm just gonna, nope, we're just, because we have fluctuating sunlight here, so that's affecting how it looks. Anyway, this is also a Q&A. If you have been a subscriber to my channel for any amount of time, you should be able to get into the chat box, which is somewhere near the video feed, depending on what device you're watching this on. So if that's you, get into the chat and I will try and answer your question. But first, we're going to cover this stuff. So let's get started. So we talked about last time, as I said, return on investment, which is kind of an informal term, right? There's an accounting definition of return on investment, but it's also kind of thrown around loosely, and it refers to a variety of different things. So we talked about the formulas for these. Now, return on investment, it's more in line with the actual accounting definition, where you talk about something that you buy and then you hold on to it for a while and then you sell it, right? And usually there's a price difference between when you bought it and when you sold it. It hopefully goes up in value, and that helps you determine your return on investment. Okay. Now, when we're talking about a company, something that exists and it's making money, like every year it makes money, right? You can own a company and it will make money for you, okay? But you don't always talk about it within the context that you're going to sell it, right? You could just hold on to it for life and every year it makes you money. So return on investment is technically not the right metric or the right calculation to use. Instead, you use something more like return on assets, which is like all the stuff that the company has. Okay, so if they own a fleet of cars, they own a building, they own some equipment, right? The value of all that stuff, if you're using it correctly, in such a way that it's making you, I don't know, $1 million a year, then you can calculate, okay, well, if it makes $1 million a year and the value of these assets are $5 million, then, you're making 20% per year, right? Which is your return on assets, right? So we talked about that calculation. There's no mention of selling anything here, right? It's just these assets, you're putting them to work and they're making you money, right? And then we went a step further because, as hopefully everybody knows, you can have assets like vehicles, buildings, equipment, tooling, that kind of stuff. And, more intangible assets like patents and intellectual property. You can own this stuff. This stuff exists, but you can finance it not through equity, but you can finance it through debt. So you can borrow a bunch of money from a bank, buy the assets with the borrowed money. So it's financed entirely through debt. And then they're making you the $1 million a year, the 20% return on assets, right? But it's a little bit of a different situation there because you're not actually putting in the value of the assets. You're just putting in a teeny tiny amount of money that's maybe a down payment, and then you're borrowing the bulk of the money from the bank or some kind of lender to finance the assets, right? So in that case, you have another metric, not return on assets, but return on equity. So what that does is it tells you this money you're making, $1 million a year, whatever it is, you're getting that based on the fact that you've put in how much money? Maybe you only put in $100,000 of your own money and the rest is debt to own the assets, right? So in that case, you're making $1 million a year after having only put in $100,000 to buy the assets. So it's a much better deal. It's a much bigger return, right? Now, just in that case alone, you can see why debt is a good thing from this perspective, right? Because it allows you to only put in this off-the-cuff example, $100,000 of your own money. You borrow the rest of the money from a lender. You buy assets that's worth, what did I say? I think $5 million. And those assets make you $1 million a year. So you put in $100,000 of your own money, you make $1 million a year. That's a pretty damn good deal, right? That's what return on equity is. So ROE, return on equity. So anyway, we covered all that kind of stuff last time. Let's take it from here, okay? Now, so what we established was that ROE, return on equity, is the key measure of performance from the perspective of the owner or equity investor. Okay, so if you're the person that owns this company outright, that controls the assets, or you're an investor, you're not actually running a company, but you're just someone who puts their money forward, right? This is going to be your main metric on how good that investment is, right? Return on equity, okay? Especially in a leveraged business. Hopefully, we all know what that means. Leverage, in this case, refers to financial leverage, which means debt, right? So if you have a lot of debt on the books, that's considered a leveraged business, right? That's how this works. Okay, so hopefully people are making sense of this. Anyway, so this kind of, now listen, like, I don't know, 20, 30 years ago, I found this fascinating because it was the idea that you can take just a little bit of your own money and you can come in and you could control something that's worth much more. Okay, that's what debt does, right? And I mean, I think everybody's familiar with this concept, the idea that, like, okay, you could put a down payment on something. You don't have to come up with all the money yourself. You only have to come up with essentially the down payment, and then the rest is financed through the lender, right? So now, as long as you can keep up with the interest payments, right, to pay down your debt, then you're fine. You don't. So even if you could afford to buy the thing outright, it may make sense. Certainly does in cases like this when we're dealing with investments, things that make money back. It might make sense, even though you could buy it outright, to put down as little money as possible and finance the rest through debt by taking a loan to pay for the rest of it, the balance of it, right? Because that allows you to be in a situation where you only put a little bit of money in, but that little bit of money is controlling something worth much more. It gives you control over something much bigger. So if you want to control a company, right, the company makes money every year. And if you control the company, if it's yours, you keep the profit, right? Okay. So if you want to control the company, if the company is worth, say, $5 million, you could buy it outright. You could pay for the whole thing yourself. It would cost you $5 million, right? And what does that get you? That gets you control of the company, and it gets you access to any profit it makes, right? Well, if you can achieve that same result without having to put in the 5 million, that's what we're talking about here. You put in essentially the down payment, a little bit of your own money, and then you finance the rest of it through debt. So if you could only put down 100,000 of your own money and then take a loan from a lender to finance the rest of the 5 million that it would cost to buy this company, you then achieve the same result. You control the company and you have access to its profit, but you only put in 100,000 instead of 5 million. Now, obviously in the real world, there's a caveat, and the caveat is that because you took out a lot of debt, you have to service that debt. You have to pay interest payments, right? So you're not going to get $1 million a year profit. You can't take that and put it directly into your pocket. A proportion of it is going to go towards servicing the debt, right? So it won't be quite $1 million a year, but it'll be less. Okay, but you still get a lot of it, right? So anyway, that's the concept. That's the idea. So that's why private equity firms want to load up any target firm they buy with debt. Okay. Now there are limits. There are limits on the amount of debt you can take out in the real world. Okay. And we're going to examine these because these are the constraints, right? So how much debt can you take out to maximize your return on equity? I've listed 5, certainly major areas that constrain you. Number 1 is the constraints directly from the lender, right? So if you borrow money from a bank or something, they will put constraints on how much they're willing to give you, okay? And they usually do this by looking at ratios, right? So some of the more popular ratios are leverage ratio limits, like the ratio between the amount of money you put in versus what they're putting in to buy something, right? Okay. Or interest coverage ratios. So the idea is that, the amount of your interest payments, how much of a proportion of that is that to the amount of profit you make or the net income you make every month. So if all of your profits are going to service the debt, that could be a problem because if interest rates go up a little bit or if your profits sag a little bit that month, then you're screwed. You can't pay the debt obligation, right? So you default. So they'll look at things like this, usually by doing ratio analysis, and they'll say, okay, we can spot you this much, but no more because of whatever ratio that's the limiting factor. Okay, so that's the number 1 constraint, right? Lenders don't just lend an infinite amount of money. They have limits based on what you're doing with it and what your situation is. Okay. Number 2, cash flow volatility and business risk. So I already kind of hinted at this. That's where if your income in your business is volatile, right? It's swinging wildly. One month you make a ton of money. You make $5 million. The next month you make 0, right? Then the month after that, you make $2 million. And the month after that, you make $0.1 million. It's just all over the map, right? Very volatile earnings. Okay, that's going to be a problem because if you are taking out debt, the interest, the servicing of that debt, it's a fixed amount. It's a fixed cost, right? It doesn't swing wildly. You're paying the same amount of fixed sort of interest, more or less, every month or whatever. So, you've got a lot of risk there with your earnings if they're super volatile. What every business wants is they want steady earnings, not volatile at all. They want a nice, predictable, repeatable, steady stream of income for their net income every month or every quarter. Because then there's very little risk. You can kind of predict what's going to happen. Therefore, you can plan what to do, right? Very simple. If things are volatile, you might be making the same amount of money, but you can't make plans because it's a more wait and see kind of thing, right? I'm trying to translate this into layman's terms so people can understand. Okay, so basically a small decline in your net income or your EBITDA, okay, for the accountants out there, can make interest payments unaffordable, right? That leads to default, that leads to bankruptcy, that leads to your equity being wiped out, essentially, okay? So private equity firms look at resilience, which is the term they use for like the ability to cover interest under a variety of scenarios, right? Okay, when deciding how much debt to apply. So resilience means like, okay, what about interest rate volatility? If the interest rates fluctuate, can you still cover your debt? What about your earnings? If you have earnings volatility, can you still cover your debt? If there are unforeseen circumstances like loss, risk management and all that kind of stuff, something happens, your shop burns to the ground, your building burns to the ground, whatever, can you still service the debt, right? That's what they mean by resilience. Okay, and they do a lot of tests on this. And a lot of this stuff is regulated, right? So, there'll be standard tests that everyone has to conform to, and then they make a determination based on that, right? Which is ultimately a good thing. Okay. Number 3, another constraint for this kind of stuff is the interest rate environment. As a lot of people know, the interest rates have been going up. They've been going down. It's been kind of all over the place the last few years. Ever since, I think, COVID hit, right? That was the last sort of huge kind of thing that we went through. There's been other stuff too. And before that, it was basically 2008, the big financial meltdown of, I still say 2008. I want to say 2008, because that's really the proper way of saying it. Just like you say 1904. You don't say 1904 or 04. You say 1904. So it would be 2008, technically. But I don't think anyone says that. So anyway, so that was kind of the big thing before that, the Great Recession, right? Where a lot of these various bank rates just kind of imploded overnight. So in low interest rate periods like, post 2008 to up until maybe 2022, okay, private equity firms loaded up on debt, right? You could get debt for cheap. You could get debt financing for cheap. So they just loaded up on debt. And then in high interest rate periods, kind of like now, relatively speaking, interest expense eats into your cash flow. You've got huge debt service payments, right? So less debt is sustainable, right? What is sustainable? Less debt. If you want to be sustainable, you want to be in a situation you can't have a lot of debt like you used to. You have to have less now, or it just doesn't. It's very risky. Okay. So central bank policies are a main constraint on leverage, right? That's the basic idea. Whatever they set the interest rates at, that's going to directly affect how much debt you can take on, obviously. So that's another major constraint, the interest rate environment. That's why a lot of firms have to be tuned into this, and if you can have a sort of idea of what's going to happen, that's going to matter a lot too. And always keeping in mind that private equity firms, when they take out this debt, the idea is that they're going to be holding on to their target firms for several years. That's typical, right? Maybe 5 to 7 years, you're holding on to the target firm, and so you're worried about interest rate fluctuations over that time scale. Not just what's happening the next quarter, but what's going to be happening sort of mid to long term. Okay. Now, speaking of that, we get to another constraint, and that is the issue of your exit strategy. Okay, because you're going to try and sell this company eventually, right? Now, the constraint really is from your future buyer, right? Now, who wants to buy a company that is loaded right up to the gills with debt, right? That's the issue. So it's good for the private equity firm that has bought the target firm and is controlling it after only having put a tiny little amount of their own equity, their own money into it, right? That's great. But the problem is, if you want to sell it, the very reason that made it attractive to you also makes it now unattractive to someone you want to sell it to, because it's loaded up with debt. The person selling, the seller, the private equity firm that's the seller, they only have a very small amount of equity in it. It's all financed through debt, right? Who wants to borrow to buy that? It's like buying a bank loan. You know what I mean? So a private equity firm might hold a company for 5 to 7 years. When they sell, they need a buyer. Often another private equity firm is the buyer, or a strategic buyer. Okay. If the business is over leveraged, the next buyer might say, we can't add more debt, and this thing you're trying to sell us is already maxed out, right? So it doesn't look attractive. That limits the valuation of this company because it's maxed out on debt, and it hurts the original private equity firm's exit price, right? So that's the thing, that there's a practical limit on the debt you can take out to finance the target firm, but this constraint comes directly from the private equity company. It doesn't come from externally, from either the lenders or the government, like the central bank. This comes directly from the seller itself, right? They don't want to add more debt beyond a certain point because it makes their offering look unattractive, right? So what's interesting here is that you're getting constraints coming from all directions on this. And finally, we got the fifth and final reason here, or class of reasons here, is regulatory pressure. Now not through interest rates, but through other means here. In peak leverage years, like before 2022, right, where there was low interest rates, there was a lot of debt kind of being taken out, right? These deals, they're usually done on multiples, right? And the multiple is, the debt versus the profitability of the firm. So usually it works out debt over EBITDA, right? I don't think we actually went into EBITDA. I mean, this is an accounting thing, but EBITDA is basically, what is the financial performance of your core business? I'm going to turn down my camera because I can see that got really bright there for a second here. Maybe something like this. Hopefully that works. Okay. So EBITDA is basically, when you strip everything away before you start worrying about taxes and, interest payments and, accounting rules and all that kind of stuff. Before you worry about that stuff, how much money is the core business actually making? That's what EBITDA is, okay? So earnings before interest, taxes, depreciation, amortization, right? Okay, so the ratio is debt to EBITDA. So if the business brings in, say, $1 million a year, okay, you could do a 5 times multiple and say, okay, well, that qualifies you to borrow $5 million against the value of this firm. If it makes $1 million a year, you can borrow $5 million, to finance that business, right? They're fine doing that kind of stuff, right? The idea is that if ever when it comes to the question of can you pay back the loan, can you pay back the debt, you've got a business that's making 20% of that debt every year. So unless interest rates are going to go higher than 20% or something like that, then you theoretically could have it covered, right? That's the idea. Okay, it's sort of like a risk tolerance thing. Okay, so the point I'm trying to make is that back before 2022, a lot of lenders were fine going to multiples of 6 to even 8 times your EBITDA, right? And that's pretty risky. So the idea is that, okay, if your company makes $1 million, we can advance you $8 million on that, right? They were comfortable doing that kind of stuff before 2022. Since 2022, when interest rates have gone a lot higher, okay, they're down. My understanding is that they're doing deals somewhere in the area of 4 times to 5 times, that kind of multiple, but no bigger than 5. So, they're a little bit more conservative, right? We'll give you $5 million, but that's maxed out. We're not going to give you any more if you're making $1 million a year. Okay. So that's kind of the final constraint. It's regulatory pressure around these multiples, okay? What they're willing to tolerate, okay? Now, just to wrap this whole thing up, okay, because we've covered these constraints about that limits debt, right? They're from all angles, okay? So we asked the question, why? Why take on so much debt, if you're just going to sell the business? What's the point of this? Okay, the answer is they leverage to maximize their own return on equity while they own it, right? So they want to put in as little money as possible, but yet control the whole thing, have access to the net income, essentially the profits, right? Okay, and because obviously the idea is that if you put in as little of your own money as possible, then you can do more of these deals. You can own more target firms, right? and you're controlling an even larger collection of revenue streams, right? That's the idea. Okay, you can add more things to your portfolio. They don't care about holding it forever. That's the thing. If they were like an owner, somebody who owns a business, they would probably not want to have their business leveraged right to the nuts. You know what I'm saying? It's very risky. That's the thing. It's not resilient. It's risky. It's probably not the best idea because essentially you're a steward of it. You're running it for the bank, essentially. And the interest payments become major constraints for you. Okay. But these people, private equity firms, they're not intending to hold on to it forever. It's a temporary thing. Okay. They buy it. They're wanting to drive the price up and then sell it. Okay. It's a temporary thing. They're looking to put in as little of their own cash as possible. So as little equity as possible. They're going to use debt to buy the rest of the company. The idea is that they're also, in theory, going to improve the business, right? This is the part where I come in, okay? This is kind of my core competency. You want to improve the company performance. Now, different PE firms care about this to varying degrees. Some really care. Others kind of, they don't. It's not a high priority for them, right? But then the idea is you want to sell the business at a higher price and then get back a multiple of what you put in fast. That's what they're in this for, okay? And I'm not a huge fan of like flipping companies. If they want to come in and genuinely improve it, then I see this as a good thing. But if they're sort of buying and selling, relying on scarcity to drive the price up rather than value, personal, I think that really skirts kind of the whole, it kind of cruises in that ethical gray area. For me personally, that's what I think. That's neither here nor there, but that's my own personal opinion. Yeah, but this is kind of what's going on. So that frames what private equity firms do, what their motivations are to do this. Okay, we see through some very basic calculations and ratios, what they're trying to do. And that explains their behavior of like leveraging the thing right up. So they could buy a healthy business that has practically no debt whatsoever. It's owned outright, which is a really good thing from many perspectives, right? But they'll take that and then they'll leverage it right up. So they'll turn its capital structure into something that almost resembles a failing business. They're leveraged right up. It looks like they're kind of on their heels. They're failing in the sense that they're making money, but it's barely enough to cover their interest payments, and they're leveraged right up, and they don't really own much outright. And that looks like a lot of failing companies. That's usually what it looks like towards the end, But they will do this intentionally because they're trying to maximize their return on equity, right? So that's the idea. And unfortunately, in doing this, they really cut it very close in terms of the riskiness of the business. If you go into a recession or something at that point and your income drops, your net income, your monthly net income starts to decline, you could be screwed, unfortunately, in this situation. But that's their motivation. That's what they're thinking, and that's why they do this, and that explains their behavior. So there you go. That's kind of my monologue on this. We could go to you guys if there's any questions. Christian is here. Christian says, I know you are from Canada, but happy July 4th, Bill. That's awesome. That's like, I appreciate it, but I just want to point out, being the technical person that I am, that would be like saying, to an American, happy Enslavement Day. It's like, isn't this a good thing? I hope you celebrate World Enslavement Day. It's like, it's the opposite of what you kind of, you cherish, right? So there you go. But no, I appreciate the sentiment, and we just had Canada Day up here. Canadians we're known for being boring, and we're known for being I don't want to say a little bit spineless, but like a little like accommodating, easygoing, that kind of stuff. At least that's my impression of it. Where I'm from, the province of Manitoba, the license plates here say friendly Manitoba. when I was a kid, I could believe that, but in the last 20, 30 years, I don't think it's really fitting anymore. The world has kind of gone, we're a little bit less decent than we used to be, put it that way. I don't think that's just a Canadian thing. I think that's a global thing. But listen, celebrate safely, don't light off, set off all your fireworks. Don't drink a keg and then decide to play with fireworks. It's usually not a good thing. So if you're here on the 4th of July and you're American and you're watching my extremely exciting talk on private equity, take it from me because I know these things. Fireworks and drinking a keg just don't mix. But hey, that's never stopped anyone before, right? So just always practice setting off fireworks for your family responsibly. Under their chairs, in through their letterbox, if you still have those. It's all good. In Britain, they have Guy Fawkes Day, which is kind of a little bit similar, where you set off fireworks, you burn effigies of this dude, Guy Fawkes, right? And supposedly, allegedly, like a couple of, maybe one generation ago, it went beyond that. What they would do is people would sneak up behind someone and stick a firecracker or something into their pocket and without them noticing and have it go off and then people would laugh about it or whatever. It was like a cool sort of way to have fun, and I'm told that people would also insert the fireworks through the letter boxes. You'd have those slits in your front door of your house or your apartment or whatever, so people could put in the letters, right? People would put fireworks in, little firecracks and things, and burn people's house down because of it. It would go awry. So if it's probably not a good idea, but if you're practicing any of that stuff, hey, you throw a little alcohol into this, and people start to think this stuff is a good idea. So just be responsible. Christian says, on my behalf of America, we also wish you a late happy Canada Day. Well, thank you very much. Happy 4th of July, Christian. Go do something fun. Go live it up. That's what it's all about. You can learn about private equity on another day when there aren't kegs involved. So that's what I'd say. Anyway, thanks for being here. You guys are awesome. If you want to learn more about business with me, and I guarantee it's a lot more interesting than what we just did here, check out that course right there, the $100 MBA. Check that out. Best bang for the buck around. You learn everything that you would learn in a MBA, in a Master's of Business Administration. If you took it from a brick and mortar university and did the full thing, you would get the same out of this if you took that. And the reason I can say that is because you're using the same source material. You're reading all the same textbooks that they are. You're getting them from the same source. You're getting them cheap. And if you choose to read them cover to cover, to do the exercises, and to really learn this stuff properly, you can get the same outcome. However, this is a lot more flexible. You don't have to go into that depth if you don't want to. You could get the book, you could skim it in a day and call it a day, and then you could learn the whole thing very quickly. You really don't go in depth, you don't get the detail, but if that's all you're looking for, then this is the solution for you. So check it out. A lot of entrepreneurs like this. It's a way to crash course business knowledge, avoid making really financially disastrous decisions in the real world, okay, because you didn't understand certain principles. You can learn all this stuff. It's great for people that are on the job, that want to be more effective and make better decisions in their job, because they will understand what the business cares about, what your employer cares about, and what you can do to help them in their goals, right? You will understand that stuff. And if you're wanting to take an actual MBA, this is a great way of putting your toe in the water, seeing what it's all about before you take the plunge, or it can give you a sort of head start from everyone else you're going to be in class with, because you're introduced to the material in advance. So whatever your goals are, check it out. I will be back next week at this time with another edition of Private Equity Rundown. Special thanks to Christian and everyone else. Have yourself a happy 4th of July, and we'll see you soon. Take care.